Pinterest stock is down close to 60% from its all-time highs, but recently it's been on the move, gaining 20% year to date. But here is where it gets interesting. Based on my 10-year forecast for revenue and free cash flow, my fair value comes in at $48.6 per share. At today's price, that's a 25% discount, also implying an estimated annual return of 20%. In this video, I'll break down what makes Pinterest unique, dive into its financials, and go through the bull and bear case to see whether it deserves a spot in your portfolio. So yeah, let's dive in. And let's start off by taking a quick look and see how the company has performed over the past year. Now we can see that revenue has grown by 19% and EBITDA has grown by close to 800%. Now that's of course due to low EBITDA in 2023. Now in 2024 the company had an EBITDA margin of 6% and the share price has risen by 17% in the past year, and the company is headquartered in San Francisco in the United States. So what makes Pinterest so different from other social platforms? Well, unlike Meta, TikTok or Snap, Pinterest isn't built around chasing likes or viral content. Instead, it's a visual discovery engine where users come to plan, dream and shop. And that makes the platform especially attractive to advertisers because people on Pinterest often arrive with purchase intent. They're looking for home decor, recipes, fashion or travel ideas and are more likely to act on the ads they see. And to better showcase my point with some data, what percentage of Pinterest users do you believe report using the platform for shopping inspiration? Is it A, 25%, B, 45% or C, 90%? Well, I can reveal that the correct answer is actually C, 90%, which is absolutely massive, showing the opportunity of monetizing these users with ads in the future. And today, Pinterest has over 500 million active users with strong momentum in international growth. The company has also been investing heavily in shopping features and AI personalization, making the platform more e-commerce driven than ever before. And on top of that, Pinterest is steadily expanding margins while growing revenue in the mid-teens. With digital ad spending rebounding, its long-term runway looks far from tapped out. And beyond the high purchase intent of Pinterest users, the bull case is quite clear in my opinion. We have ad and commerce expansion with shopping integrations, AI-driven recommendations, and growing international user base. Pinterest has multiple levers of growth. In addition, we have operating leverage. Margins are improving as the business scales. Now, it's not all perfect, right? We have a bear case as well. First, we have competition. Meta, TikTok, and even Amazon are fighting for ad dollars. And we also have user growth ceiling. Most of Pinterest audience comes from outside of the US, where monetization rates are lower. If user growth plateaus or the average revenue per user stalls, then the upside may be limited. Okay, so now we have a sense of what makes Pinterest so unique as a company. Let's now take a look at some historical financial data going back 5 years in time, and here I have the core financial performance. So we can see the revenue in blue and we can see the EBITDA in green. Now what's really interesting here is that the revenue has grown consistently, right, each year by 21% on average. Now the EBITDA has been slightly different, right? We can see it's been slightly inconsistent, but in 2024 we can see that the company regained a healthy 6% EBITDA margin and the company continues to expand its EBITDA going into 2025. Now let's move on and let's take a look at the company's debt sustainability and see if debt is any risk for us as investors going into the stock today. Now here we can see the debt of the company in purple and we can see the excess cash in green, showing that the company doesn't even need its EBITDA to pay down its debt as it has so much excess cash on its balance sheet, which is great to see as a potential investor. Now, as we later on will use the company's free cash flow in our valuation, let's also take a look at the company's free cash flow performance over the past few years. Now here again we can see revenue in blue and instead of the EBITDA we can see the free cash flow to equity in green, so that's a relevant free cash flow for us as equity investors. So yeah, we can see revenue has grown consistently and we can see a much stronger free cash flow, right? And in 2024 the company had a free cash flow of close to $1 billion, showing us that the company is becoming, at least on a free cash flow basis, much profitable each year. Now the final chart I would like to show you has to do with the share performance of the company. Now here we can see it across two dimensions. First we can see the average yearly share price as the dotted line and we can see the shares outstanding within the company. Now the shares outstanding have grown by 4% per year, which is quite high. However, we can see a huge spike right in 2021 and since then the shares haven't really grown that much, right? So I believe that the share dilution in the future will be much lower than the 4% we've seen each year in the past 5 years. Okay, so let's move on to the interesting part, which of course is the stock valuation. And I'll start off by showing all the assumptions in my valuation model so you know exactly what I've included in my estimates to get my fair share price. And this goes all the way up to 2034, so basically 10 years including 2025. So let's start off with the average yearly revenue growth I have in my model at 14%. Now that's much lower than the 25% we've seen per year in the past 5 years, assuming that the company will become bigger and growth will slow down. Now in terms of EBITDA margin, I'm assuming 30%. That's much higher than the average of 2% per year in the past 5 years, and this is where the whole investment thesis lies, right? That not only the company can grow its revenue, but it also can become much more profitable at the same time. Now in terms of enterprise value to EBITDA multiple, I'm assuming 22 times. That's much lower than the 93 times we've seen in the past 5 years. As the company becomes larger, growth will slow, right, and the multiple will compress. Okay, so let's move on to the free cash flow assumptions as well. So here I'm assuming 16% free cash flow growth on average per year. That's slightly higher than the revenue growth, assuming yet again that the company will expand its free cash flow margin over time. Now the free cash flow yield, that is how much free cash flow we get relative to the share price, I'm assuming at 4.5%, and that's much higher than the 1.3% we've seen on average over the past 5 years. And finally, the discount rate I use in my discounted cash flow analysis is at 9.8%, which I think is quite fair for a company like Pinterest. And yeah, here you can basically see an overview of the revenue and the free cash flow that I'm forecasting for Pinterest all the way up to 2034. Now what you can see here is that the growth rates in 2025 are basically in line with the company's guidance, and then I have basically decelerated the revenue and free cash flow growth all the way down to 2034. Now in addition to this, I'm also forecasting that the free cash flow growth, as this green dotted line, will be higher than the revenue growth seen as the orange dotted line for pretty much all of the years except for 2034, as the company will become much more profitable on a free cash flow basis as well. So yeah, if we discount all the future free cash flows that I'm forecasting in my model, we get a fair share price of today at roughly $48.6. And this also shows that the current share price is trading at a 25% discount. Now in addition, this also implies an annual expected return of 20% per year, which easily beats the S&P 500 at roughly 9 to 10% per year. And here you can see how it might look if everything goes according to plan. So of course you have to buy or invest in the stock today, you get some free cash flow in 2025 as well, and then you get free cash flow distributed to you as stock buybacks or it could be dividends, right, all the way up to 2034, where you sell the stock at its exit price. Now this also assumes that the shares outstanding in the company will continue to grow, right, at the lower pace of just 2% per year. Now the bull case that I've just presented of course assumes optimistic assumptions for growth. Now let's also take a look at the bear case scenario and see what happens to the fair share price and the annual return if revenue growth and free cash flow growth are not in line with our expectations. So in the bear case, I have revenue growth at 7% and free cash flow growth at 8%. So basically half of our bull case. Now if that were to happen, the fair share price drops to roughly $26 per share, and in that case the current share price is trading at a 41% premium and the annual return drops down to 6% per year. So if the company does not perform in line with our expectations, then we could basically underperform the market in the coming 10 years. Now this also shows us a massive opportunity. If the company performs in line or above our expectations, then we could also massively outperform the market as well. Now let's take a look and see how Pinterest compares to other stocks I've talked about on my channel. And here you can see basically a two-dimensional investment positioning landscape where we have the weak businesses to the left and the great businesses to the right. At the same time, we have the undervalued stocks to the top and the overvalued stocks below. So we want stocks that are up to the right where they are undervalued and also great businesses at the same time. Well, I'll actually place the stock here, right? I think it's a strong business. It's not as great as perhaps Microsoft or Visa. However, in my opinion, Pinterest is undervalued right now, making it an interesting investment opportunity where it's both a strong business and undervalued at the same time. Now, what makes a great stock, in my opinion, is not only that it's a great business and that the stock is well priced in the market as well. It needs a third element that I call momentum. So yeah, let's take a look and see if Pinterest has any technical momentum right now. And yeah, here we can see the stock chart of Pinterest over the past few years, and it's quite clear, right, that stock price today is far from the stock's all-time highs back in 2021, where the price was close to $90 per share. Today it's trading at less than half of that, at roughly $37 per share. Now, if we zoom in a bit, I'd actually say that the company is regaining its long-term momentum. We can see that the stock price is following its upward sloping trend line, and we can also see that the current share price is above the 200-day moving average. So that's the average share price over the past 200 days. Now, you might wonder, why am I using the 200-day moving average instead of the 50-day or 100-day moving averages in my technical analysis? And I got the same great question by a viewer just a few months ago, and the answer is quite simple. So the 200-day moving average is seen more as a key long-term trend indicator, meanwhile the 50 and 100-day averages are more short-term and mid-term. And here at Investing Edge, we're always long-term in how we invest, so that's why I'm using the 200-day moving average. So if you are interested in investing in Pinterest today, it would make sense to start nibbling at a few shares at the current share price, or wait until the share price declines and bounces off its long-term trend line, which we have seen has happened quite a lot in the past. And here you can basically see what happens to the annual expected return if the stock price would decline, or if the stock price would go up. Now we are at 20% today. That's good enough for me if I'd enter the stock today. Now, if the stock price would decline, you can get even higher returns. If the stock price would, however, go upright, you can see that you'll still get market-beating returns. It all depends on where you as an investor feel comfortable entering the stock. Now, given the discount the stock is trading at today, I've given the stock a buy recommendation and 4 out of 5 stars as my final rating. And yeah, here you can basically see all the key considerations that have gone into that final rating. Where the company hasn't really performed that well, first of all, has to do with the EBITDA growth. However, that's the whole investment thesis, that the EBITDA growth will turn around and become really strong in the coming years. Now, in addition, the stock performance hasn't really been that consistent. However, with better profitability and continued revenue growth, I have no doubt that the stock performance and consistency will improve in the coming years, making this a very interesting opportunity for investors. Thank you so much for watching this video. If you found it informative, please feel free to like and subscribe. So yeah, thank you, and I'll see you in the next one.